I traded divergence for 4 months straight, and this is what I discovered. There are two major ways people use divergence in trading. I'm going to break both of them down so you see for yourself what my discovery is. I will also be refining these strategies to even make them better. But first, let's start with what divergence actually is. So what is divergence? Divergence simply means price is moving in one direction, but your indicator is showing the opposite direction. There are two major types of divergence. We have the regular divergence and the hidden divergence. Regular divergence is used to trade reversals. So for example, you can see from the chart here, for regular divergence, the bullish case, price made lower low here and the indicator made a higher low. This is an early indication that price is going to go up. For a bearish case, price made a higher high here and the indicator made a lower high, which is an early indication that price is going to go down, and price is going down. Let's look at it on a real chart. So for a bearish scenario, you can see here that price made a higher high here and the indicator made a higher low. It is an early indication that price will go down, and price did go down. This is the same for a bullish scenario. Here, price made a lower low here, but the indicator made a higher low, which is an early indication that price is going to go up. And we can see here that price did go up. The indicator we use for divergence include the RSI, CCI, OPV, stochastic RSI, awesome oscillator, money flow, momentum indicator, and the MACD. But for this video, what I'm using here is the RSI. The other type of divergence is the hidden divergence, and it is used to trade with the trend. In a bullish case, price makes a higher low while the indicator made a lower low. This confirms that the trend is going to keep moving high, and this is our entry. In a bearish case, price makes a lower high while the indicator makes a higher high, an indication that price will continue in that trend, and it did continue that way. So this is an example here. We can see here that price made a lower high while the indicator made a lower low. And here for a bearish case, price here made a lower high while the indicator made a higher low. So which of these type of divergence should you focus on? Let's start with the regular divergence and the two reasons why it fails a lot and why you should just keep away from the regular divergence. The first reason is that by the time you spot a regular divergence, price has already moved. Yes, you will see the divergence clearly on the charts, but when you try to enter, your stop loss is huge and your entry is late. So you end up chasing that particular mode. See what I mean? So this is a regular divergence, right? So price is making a higher high, indicator is making a lower high. Now, by the time you spot this divergence, price is already at this particular point. So your entry would be here. Your stop loss is huge, and you are meant to target it. So you're getting around a 1.3 1 ratio. In this case, it did go down further, but in some cases, you're not really going to get a very good risk reward ratio. If you look at the other scenario, this one actually gave us a good risk reward because we're going to enter around here. The risk reward is not that good. Again, this is just 2.6, but if you're targeting here as a high, it's less than 2. Now, the second reason is that the regular divergence can fail a lot and you have a lot of losing trade by taking it. See what I mean from here. So here, if you look at this particular one, this one we have here, we actually first of all had a regular divergence to this point. So this is the first regular divergence. So let's say I took this trade here. This is going to stop me out before it went my way. If you check most regular divergence you have, It might happen 2 or 3 times. It might take you out the first time and take out the second time before it goes that way. Now let's look at how to trade the hidden divergence. First, you have to stick with the higher time frame because there are less noise in the higher time frame and more noises in the lower time frame. Now, the next thing you do once you have chosen your time frame to trade a bearish trend, the first thing you do is to look for a breakout structure. So when you spot the breakout structure to the downside, I'm just going to label it. Once you spot it, this is the high that formed that breakout structure. I'm going to mark up the high this way. I'm also going to go to the indicator and mark up the high this way. Now, the next thing is, once the RSI crosses this particular line we marked, the horizontal line, we check this one. This line is not crossed, so this is giving us what? A hidden divergence. So what I'm going to do is I'm going to take the Fibonacci tool, take it from the top and take it down and extend, and my entry is going to be the 705. Okay, so I'm going to pull this short position, put it at 705, limit order, targets, put my stop loss at a swing high, and targets at least a risk reward ratio of 2.5. This one gives us much more than 2.5, but I'm targeting at least a risk reward ratio of 2.5. Or the first entry or the second entry is actually fine. So this will be how to enter this particular trade. Let's look at another one. So what do we have here? We have a break or structure again at this particular point. So this is our hidden divergence, this one, and so this one, and this is our hidden divergence. Okay, now let's look at another one. So we have a break or structure here. So what do? We mark out the high that caused that break, which is this high here. Then we also mark it out here. Now we didn't have a break until we got to this particular point. This is the point we had a break. So once we have that, I'm going to pull out my Fibonacci tool. Then I'll pull it from this top to the bottom here. So what is my entry? My entry will be at the 705, stop loss at the swing high, and take profits at least 2.5. Okay, or target this particular zone. Now, I wouldn't take this trade because it took a long time to happen. We can actually not take this, but go down and look at the next breakout structure. This is the next breakout structure here. So have a breakout structure this way. Then what do? This is the high that led to that breakout structure, this particular high here. And I'm going to mark out that same high on the indicator, which is this one here, this particular one. Now, when this high is broken, what do? It is not broken as well here. So what do is that I take the Fibonacci to take it from here to the bottom here. I can see we just hit that 705. Short position from here. We target, put our stop loss at the top, and I'll take profits at least 2.5. We didn't get up to this particular point, but we got our 2.5 clear. For a bullish scenario, let's look at a bullish scenario. So what do we have here? We have a break or structure this way. And when we have a breakout structure, what do? This is the low that caused that breakout structure. So I'm going to mark out this low this way. Like this. I'll do the same thing here, mark out the low like this. So once this is broken, I won't enter here once it's broken. I'll go ahead and pull my Fibonacci retracement tool like this. Then my target is always 705. That's my entry. Stop loss here, and we'll target a 2.5. We almost always hit a 2.5. You can see that this gives us a much more accurate divergence. It works a lot of the time, and it is far more reliable than a regular divergence. So if you are going to trade divergence, this is the one you should trade. But there are two big problems with this divergence. One is that trades are hard to come by using this method. You might see only a few setups a month, so you need to be patient when using this. Now, the second one is that you're going to miss a lot of trade while waiting for it, because if you are just using market structure, there are lots and loads of trade to take here. For example, we can also take multiple trades here that the divergence didn't show, as well as also take multiple trades here. So far as the market is trending, we can see a lot of trades to take, but the divergence, hidden divergence, is not going to show this. What is going to show it is market structure. Market structure is the real foundation. So if you want to know how to spot this extra trading opportunity, then watch this next video here.